My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Imran Lakha. Imran, you've been in business for a while. Introduce yourself to the audience. Who are you? How'd you get involved, interested in markets? And what made you gravitate towards options in particular?
Okay, so been around a while. Started my career in 2001 at Credit Suisse, funnily enough. Obviously, they've been in the headlines a lot. So just kind of built my career trading index options as a market maker for the banks. Ended up going to Merrill Lynch for a while, which then turned into Bank of America. So I had some experience trading through the great financial crisis of '08. And then I ended up running the desk at Citibank for a little while. I had a short stint on the buy side as a macro PM. And then about 4 years ago, I set up my own options education business because I decided, you know what, this sort of knowledge needs to be a bit more democratized. I think I can teach this stuff fairly well, seeing as I've taught so many juniors over the years who've gone on to make a lot of money at the banks. So why not start trying to teach everyone else? So that's what I've been doing.
So the institutional background when it comes to options, I think, is interesting because a lot of people that claim to be options traders, and I say claim because you don't really know, don't really have that real sort of institutional background. Um, how is that? How has your career experience helped you think about options relative to others that are trying to educate on that means of trading and getting exposure to an asset?
Yeah, so I just think because I've approached it from the side of being a market maker at these big banks, my client base was not retail traders. My client base was institutions. So I learned the techniques that institutions used to hedge portfolios primarily. And then obviously, you'd have the old hedge fund types that would put on speculative bets and things like that. But, I don't think a lot of the educators out there I think a lot of the educators out there who haven't really traded for that long are coming at it from a mindset of, options allow you to get great leverage, and really it's kind of a supercharged way of stock picking. So what are the stocks that I think are going to explode, and I'll buy out of money call on them, and that will give me loads of leverage, right? So the way I'm kind of educating my audience and my members is you can do that, but there's a whole load of other things you can do with options as well, right? You can overwrite. You can have stock positions that you're happy with, and you can systematically overwrite them, right? And you can earn yield on top of those. That's something that is done by institutions in billions and billions of notional because over the long run it works. Similarly, you might have a short-term view that the market's looking a bit ropey right now, but you don't want to puke all your stock holdings. So what do? You find a liquid index proxy and you can put a macro hedge on over the top of your portfolio for 3 months, 6 months, whatever it is, and that can protect you. And then when you do that, if and when you do that, how do you think about monetizing those things? How do you think about monetizing those hedges when they actually work for you? Which again is something that a lot of institutions, in my experience, don't even do very well. So I'm trying to educate people about those sort of ways of utilizing optionality.
Yeah, and actually, I think you said it absolutely correctly. The difference is going to be one's viewing it or starting from the standpoint of speculation as opposed to hedging. Right, institutions much more hedging, others more to the appeal of the outsized returns. Now, the challenge with options and hedging is that you obviously need a degree of volatility that comes in these kind of waves. I had a space with someone not too long ago who made it a point that last year was the only year in his career where he lost money on his hedges because
Mhm.
volatility, while elevated, didn't really have the sort of the super spike. So it actually, he argued, made it hard to make money hedging with options in a year like last year. Take us through the audience for a little bit how options trading was in 2022 for you, and bring it to the present now that there's seemingly a lot more volatility and tail risk suddenly wagging itself.
Sure. Yeah, so I think, after the first sort of 3 to 6 months of last year, we had a bit of weakness in markets, but we had seen, as you said, no vol spike, no real super vol spike. And the way I rationalized that last year was that it was very well telegraphed, right? We knew from the end of the previous year, the tightening cycle was on, they had a lot of catching up to do, they were behind the curve. And in general, that wasn't going to be great for risk assets. So when the kind of weakness in the market is so well telegraphed, it's not a real surprise, right? So then the idea is, anyone who wanted to put on protection and put hedges on or de-risk their books, they had quite a lot of time to do that. And so you're going to really need something out of left field that isn't anticipated by the market already to get a super vol spike. And we just didn't get that. We just got the market dripping lower as everyone was kind of expecting it to do as yields went higher. Now, from a hedging perspective, there are ways to make money in that environment off your hedges, but you have to be able to do short vol hedges, right? So you need to be able to do what we call put spread collars, where you buy a put, you sell a put behind it. So you have a limited amount that you're going to make on the way down, but you're still going to make something. And then you finance that put by selling a call option. So put spread collar, a very, very commonly used institutional hedging strategy that worked like a charm last year, right? What didn't work last year was owning VIX futures and hoping that you were going to get some super spike that you were going to be able to monetize, right? So, there are, for every type of market environment, there are types of option hedges that will do well, right? There are some that won't do well. And your job as a hedger or as an option expert, or my job, let's say, is to try to identify what is the optimal hedge for the scenario we're in, basically, right? And that's the idea. Now, moving to this year, yeah, I mean, there's definitely been more vol, and also, I mean, the vol's really been in the rates market, right? So we've had equities obviously winging about a bit, but the real outstanding volatility has been in rates, and even within rates, it's been in the front end, right? So, and this is funny because my subscribers will know that we have been flagging SOFR options for the last month as the way to hedge, right? Because we had a scenario where terminal rates went screaming up to 5.6, 5.7. You had the volatility in the front end of the SOFR futures, which are like your euro dollar futures, but we're moving over to SOFR contracts. So these are your short-term interest rate futures. The volatility was quite low at the time, and you had a bunch of catalysts like inflation data, like non-farm payrolls, which if they came in a little bit lighter than market was expecting, because we had been getting so much hot data since February, there was a reasonable chance that terminal rates were going to pull back a bit, right? So from 5.6, 5%. So we never claimed to call the Silicon Valley Bank collapse and this massive banking crisis that just came out of nowhere, it seemed like. But what we did say is the risk reward of owning some upside in SOFR makes a ton of sense because the recession was essentially just priced out, and you had very, very low probability of a recession rearing its head this year. And the way I was implying probabilities for that was looking at call spreads in 1 year or June 24 expiry SOFR call spreads quite far out of the money, implying like a 2% interest rate in the US. What were they implying? And they were implying like a 12% probability of a recession by June 24. And when I say there is some subjectivity to that interpretation, but I was saying, well, in a recession, I think rates are going to go to 2%, or they'll be pricing rates to be 2% by June 24. So the call spread that is up there at 2% is priced at 3 cents, and it can make 25 cents, which means that's an implied probability of about 12%. So 12% to me seemed just the wrong price. So I bought some of those call spreads, as did some of my subs. And the idea was at some point throughout the summer, maybe into September even, that thing will reprice itself to maybe 40%, 50% if a recession looks more likely, and then we can unwind that and monetize those. So those are the type of hedges that we were seeing early this year that were making the most sense to us.
I remember very well. My father had said to me when I was much younger, obviously, and this is before he passed, obviously, said to me, never play with options. And he said that because from his bias was, he said, the reason he would say that is because you never want to play against time, right? He was viewing more from sort of a time aspect. And I always thought that it was interesting to think through as an experiment, in the sense that you can be right about a thesis, but it has to happen in your time frame to make money off of it if you're doing options, right? As opposed to directly holding an asset. How do you think about managing time when you have a particular view? Because you're going to keep bleeding, and by the time the view comes true, you may have bled out.
Yeah, exactly right. And that's the mistake so many people make when they haven't traded options for 20 years like I have. So the idea is, yeah, you know that you're fighting the decay monster, okay? But the idea is that the decay really kicks in when you're going too short dated. Okay, so the idea is not to be so arrogant in your view that I've got a view on this asset going up or down, and I know I'm going to be right within a month, or I'm going to be right within a week, like a lot of people are doing these days, right, with the super short dated stuff, because the chances are you're not going to be right straight away, and if you're not right straight away, you lose all your premium. Okay, that premium evaporates pretty damn fast. So the way you manage the bleed is in a few ways, right? You can trade spreads instead of trading outright options. So like that's put spreads and call spreads instead of just puts and calls. That keeps your decay down a little bit. It limits your upside as well, but that's maybe the lesser of two evils. And then the other thing is you go longer dated. So you say, well, I think the move's going to happen in a month, but I might be wrong. So I'm going to buy a 3-month option instead, or I'm going to buy a 3-month spread instead. Okay. So that you're always cognizant of the time decay. And let's say I do. In fact, I said something in my daily note today, right? I said, Euro looks a bit toppy. The dollar has sold off in the face of the latest crisis, which is not typical of the dollar when you're getting a risk off type dynamic. But the reason it's happened is because the repricing in rates has been so dramatic in the US relative to others that they've been selling the dollar. Now, finally, we're seeing a bit of banking stress spill over to Europe. Deutsche Bank was obviously down heavy today. CDS spreads across the European banking sector are spiking after what happened in the AT1 bond market after the Credit Suisse wipeout. So these factors are now starting to spill over into Europe. And the idea being that economic surprises in Europe are also rolling over relative to the US. So is there going to be a catch down in Euro once we see that the ECB can't just keep hiking in the face of what the Fed is being priced to do, right? Powell already kind of told us it's probably done because the amount of the impact in the credit market, right, of tightening lending standards is going to do a lot of the work of further hikes that will, so they don't need to necessarily move rates anymore. And the market's saying they're going to be cutting rates by June. So I don't know if that's true or not, but let's say they do. Are the ECB really going to keep hiking at the pace that is priced? And if they don't, as soon as we get that conclusive pivot, euro is going to be toast, right? So if you believe in that view, and you might not believe in it, but let's say you do believe in it, then you're going to be looking for downside in euro. But buying a 1-month euro put is not the way to play that view, right? What you do is you say, okay, well, how long might I have to wait before euro actually does catch down? Before I start to see it in the data? Before I start to see European inflation really rolling over? And I know that lags against US inflation, right? And so the idea there is, I would go to September expiry, which might feel like a long time away, but in FX options, they're notorious, right? FX pairs are notorious for they trend, but they trend quite slowly, right? So what I'd be looking for is a reversal in the euro trend back towards the downside once we get a conclusive pivot out of the ECB, and the US has already been priced into cutting rates quite hard, and so owning quite far out of the money, maybe parity in the euro, those sort of strikes in September is a much better way to carry that bearish put on euro because it's not going to bleed away in the next few weeks. It's with you for 6 months. You've got a lot of time for things to play out. And as it happens, you can do other things against your trade as well, right? Let's say, for example, I bought some puts on euro and euro rallied to 115, okay? There can come the point where I can and let's say that happened in the first 1 or 2 months of the trade. So I bought a 6-month put on euro, and in the first 1 to 2 months of the life of that option, we rallied 5 big figures or something. We went to 113, 115, whatever it is. So I've got the option there if I want to. I know the option that I bought has gone quite far out of the money and probably lost most of its value, but it's not dead yet. It's there for another 4 months, right? And what I could do, arguably, is I could sell a call option now because euro's at 115, and if you look at the really long-term structural downtrend in euro, you've got this big channel been in existence since 15 years plus, and the top end of that channel is 115. So you might say to yourself, now that we're at the top end of this channel at 115, I feel a bit more comfortable selling some call options to get some premium back. So the premium that I spent on the put, maybe now, if I have the higher conviction that this is just a crazy level for the euro that I don't see breaking for XYZ reason, you've always got the option to do other option trades that can get you back some premium, right? So it's a lot of people think when they trade an option, they're stuck with it. They're stuck with that trade. They can't restructure. They can't do anything with the trade that they've got on. I think quite the opposite when I trade options, right? Like, what is the optimal thing for me to do right now to reflect my view about vol and spot and skew and all these various parts of the vol surface where I'm trying to identify decent value? But as my views evolve and as the market evolves and as time passes by, then there's lots of things that I can do to trade around that. And that's what I'm constantly doing. I'm constantly reevaluating my option position. I'm saying, the way the Greeks are evolving in this position, are they evolving to reflect my view today? Right? And that's something I think a lot of people need to learn more about. Like, the Greeks of a trade on day one might look quite different to the Greeks of a trade 2-3 weeks later. And do they still reflect your actual views? And if they don't, there's nothing stopping you restructuring that. And that's kind of how we think about it.
By the way, I will say it's interesting you mentioned that September timeframe. I've been very public on this thesis I have, which is based on my own analysis, not of all of which I reveal on Twitter, obviously, that if there is a credit event, I think it actually happens later in the year, that this regional crisis, in quotes, is not it. And if you're going to have something that is a credit event that might bring back the dollar as the risk-off safe haven play again, right? In which case that would bring the euro down, right? Obviously. So, it's always interesting to me to hear other traders kind of come to similar conclusions in different ways, which I think is a nice aspect of connecting to people like you on FinTwit. I want to go back to the word you used in describing the time frame point. You said the arrogance, right? Which I think is just I smiled when you said that, because I think that you can make an argument that there is a hell of a lot of arrogance in the options trading community because of how much is going into zero DTE. I mean, I think that, right. I know, and I'm sincere when I say that. I think there's a strong correlation between, being a gambler and being arrogant, right? So I am curious to hear your thoughts on how zero DTE trading has maybe changed the dynamics of the options community, and does it actually make longer term option holders more likely to succeed?
Yeah, that's an interesting point. I mean, I think that, I mean, if we look at the data, it's not all retail, right? I mean, there's the majority actually of institutional types that are trading these things. So then the question is, what are they doing? Why are they doing it? And Mike Green has spoken quite publicly about his views about that, right? And that you could, you got systematic overwriting, which has been around forever as a way of yield enhancing a portfolio. Okay, now you can sell 1 month options and lock in a certain strike and a certain rate and have to wait over a month to get your theta, or you can do a smaller slice but do it every single day, and arguably that's going to give you a better risk adjusted return, right? So it makes sense that there should be a systematic desire to sell very, very short dated optionality from the institutional community. But then you've got the flip side where you've got these massive data points that come out, on a periodic basis, because we're in a world of quite extreme economic volatility that we haven't seen for a long time, right? So in the days of low inflation and QE, nothing ever moved because economic data really didn't move either, right? But since COVID, we had such massive distortions that the economic data volatility went through the roof. And at the same time, so these data points, because the Fed got it so wrong on transitory, they then became very, very data dependent. And it's not like we need to see a 6-month trend in the data. We care about every single data point, right? So non-farm suddenly matters so much. CPI matters more than it ever has done, right, in decades. So the fact that these data points become so supercharged gives market participants on the hedging side, and even institutional ones, that it gives them a reason to say, well, why am I locking myself into a 1 month hedge when all I really want to hedge is the next CPI data point? So a day before the CPI data point, I'm going to buy that option, right? I'm going to buy a put to hedge that scenario, or whatever it is, a put or a call. A lot of the time people are using calls now to hedge because they're so underweight stocks that they need upside hedges, not downside hedges, right? So I think you've got institutions systematically selling. I think you've got the big data points suddenly find a load of buyers because there's a need to just hedge that one data point because the market cares about it so much. And then you've got retail speculation as well, where there's nothing that's going to give you more leverage than a 1 day option. Chances are it's going to die, but if it doesn't die, you might make 10x out of it, and you might get yourself rich quite quickly. So there is that gambling mentality, the whole speculation around meme stocks that then filtered into tech stocks and in general, and now is filtering in and crypto, obviously, and now is filtering into zero DTE space because they've just got the appetite, they've got the risk appetite for it.
Yeah, I find the whole thing utterly bizarre. I have to tell you. I mean, but I'll take it a step further because I think it's more. It's not even just zero DC. Just it relates to just day trading in general. I mean, if you're really going to be bullish on markets, it's very simple to identify what the contrarian signal is. It's short termism, right? Because if you're confident in the future, you're not going to trade it short term, right? I'd argue there's a direct link between confidence and time frame with which anybody trades anything, whether it's options or individual holdings. So the fact that you end up having so many people day trading and doing zero DTE, if you're a real contrarian, you say to yourself, there's a time arbitrage there, which should mean that bulls, long-term investors would have an edge because nobody is really thinking in those terms anyway.
But I think long-term investors do have edge because think about why momentum works, right? Momentum, people who just ride trends forever, right? Why do trends work? Because you're kind of getting paid for your patience, basically, right? You're getting paid to not get stopped out of that trade, right? You're getting paid to just say, I've identified a long-term structural trend and I am willing to just sit with that trend and be patient, right? So, you know how there's risk premium in carry, there's risk premium in all various types of things. I believe that's where the kind of alpha is in chasing trends, is that most people aren't patient enough to sit in a trend for long enough.
Yeah, no, I 1,000% agree with you on that. Yep.
Yeah, yeah. And then the last point on the zero DTE, I would just say is it does seem, and this is something Jim Bianco talks about a lot, and I totally agree with him, right? It does seem like there is mean reversion intraday because of the existence of these zero DTEs. So, if you've got people who have speculated intraday on zero DTE options and they've worked for them, well, they're not necessarily going to wait until the closing print for that thing to settle. They're going to get out of it in the last hour, half hour, whatever it is, and so that's going to create mean reversion flows. So you're going to potentially get some intraday movement because the fact that market makers have been taken out of that optionality makes them short gamma, and they're chasing their tail on a move. Let's say there's a piece of data that makes the market move, but then when that flow comes back to unwind, it does kind of move the market back the other way.
No, but by the way, that's actually important for the audience to keep in the back of their minds. So I did this study. I put a tweet about it. So typically, autocorrelation, right? In other words, the future being correlated to the recent past is strongest at weekly time frames. Typically 3-4 weeks. That's why the momentum phenomenon, to your point, exists, and it's typically on that weekly frequency. There's much more. So there's more streakiness using week over week. When you're within a week, Monday through Friday, there's a lot more mean reversion. So that's why they call it turnaround Tuesday, right? When you have a big down day on Monday. So that point I think is valid. I hadn't thought of it myself or studied it, but it does make sense that if mean reversion is more likely within a week than within a day, it's even more likely to occur, which just makes everybody lose their minds more on FinTwit. I'd argue.
Yeah, and we're seeing it. We're definitely seeing it, right? You can look at the intraday price action, and it's consistent. I mean, Jim was putting it on his Twitter, right? Charts of just showing you the 1.5% swings that were just constantly happening. And net, the market's not going very far, but the swings are there for all to see.
Let's talk about sectors for a bit here when it comes to options positioning and trading. You mentioned the euro side, but presumably there's some sectors that might be better for certain option strategies than others because certain sectors are more volatile than others and more likely to have surprises or relative convex type of movements. How do you think about sector focus when it comes to option strategies?
So I tend to look cross asset, but I look a little bit at sectors as well. So you looking within sectors. I mean, I don't look at every single sector, but I look at tech, healthcare, energy, metals and mining, financials, things like that. So obviously, financials vol has gone through the roof, right, for obvious reasons. But then you've got this dynamic where the more stressed financials are becoming, the more the rates curve is moving as a consequence, and that is supportive of tech. So then you're seeing tech vol doing not a lot, right? Tech vol actually is looking quite cheap and quite low because tech stocks are proving to be the safe haven right now. Okay, so you get these divergences between them, between what's going on in the different sectors, and similarly gold, right, in the cross asset space. Gold vol had got really quite low into the low teens before the latest explosion higher, and now that's starting to catch a massive bid because people are realizing that gold is now threatening 2000, and if it breaks those highs at 2070 or wherever it got to, then the sky's the limit, and people might be calling it to 2500. So suddenly gold vols come alive as well. So what we try to do is in our service is we try to track all the different cross asset vol that's going on. So equities, FX, commodities, sectors, bonds. And we try to look at the skew, if there's significant flips around in that skew. So the gold skew completely flipped, gold and silver skew completely flipped from puts to calls as that upside demand came in. So sometimes it's not like an exact science, but sometimes by looking at all of this stuff, you will sometimes start to get early reads on things, right? So when you start to see a divergence in what skew's telling you versus what the spot market is doing, that's when you start to pay attention and think, okay, even though the spot market's not really moving yet, someone in the options market is paying for upside. Okay, so someone sees a reason to start repricing the relative tail risk on upside in gold compared to downside and things like that. So those are the things we're always constantly trying to look at under the hood to try and get a read, right? We've been saying to our guys, it's frustrating. Like, how you're saying you're doing all these podcasts and stuff and trading at the same time. This is the thing that I struggle with, being able to actually trade my book. I'm constantly generating ideas and doing commentary and doing my content, but to actually then go and trade half that stuff is another full-time job, which I just don't get around to doing. But one of the trade ideas we put out was, we noticed that the volatility between silver and gold was diverging quite a lot. Like silver vol was quite expensive relative to gold, and we thought that on the upside, gold would kind of lead on a vol adjusted basis. We thought, gold would be the driver. It may take silver with it, but the idea was to sell puts on silver because the vol was so expensive and silver was already not really rallying that much. So it's like it was already quite cheap silver. So how much cheaper was it going to get? So you're selling puts on silver, and with the premium, you then load up on gold calls because the gold vol is trading at a massive discount, and then you get the convexity of being long the call to the upside, but you can buy more notional in gold than what you have to sell in silver because of the vol differential. So there we were able to, identify a volatility arb type opportunity, like a relative value opportunity in vol, but then express the bullish precious metals opinion and get into a trade that had really nice positive convexity on the upside. And that trade, for those of them who managed to get it on, has worked quite nicely because that gold vol's exploded on the way up.
Just for the remaining 25 minutes here, let me reset the room for everybody here. Please make sure you follow Imran Lakha here on Twitter. Check out his website if you're really interested in getting a much deeper dive on options, options-insight.com. If any of you want to come up and ask questions, don't hesitate to click on that bottom left mic request button. And as always, this will be an edited podcast on all your favorite platforms. By the way, to your point around having all this content and then trading, this is one of the reasons why I have a rules-based approach in the way that, because to your point, it takes a lot of time, right? Not just to market and put content out there and engage, but to actually execute is a whole different animal. You can argue in the context of all that. I'm curious in the most recent last couple of weeks here with this in quote crisis, which we can debate. Has it been surprising to you that markets haven't really gone down hard, or rather that there's so much dispersion? And where I'm going with that is, if it's a real crisis, everything correlates to one. You wouldn't see a rotation from financials to tech. You'd see a rotation from financials and everything into cash or treasuries, right? Has the relative movement been surprising? Because I think this is where, as much as I remain largely bullish for the year and keep saying that this is volatility, not direction for March, the rest of the month, you can argue that bulls and bears have both been right so far.
Yeah, I think it's all about the rates fall. Like something that people look at a lot is they look at the move index and they say, oh, move's going up, so VIX must follow it, right? And I think I just don't think that's valid, right? Sometimes, yes, it can happen, but the biggest thing about rates vol is it creates rotation in the equity market, right? So you have your value sectors getting trashed, you have your tech sectors going up when rates are coming down, and then vice versa. And that's really what we've seen, right? We've seen such a violent move in front end rates that that's what it's triggered. It's triggered this massive rotation back into tech, where people are exiting cyclicals. Clearly, they're exiting financials, but they were underweight tech enough to then be buying that back. And when you got the likes of Apple and Microsoft doing what they're doing, and you've got the AI innovation that's happening, I mean, that's a big story, right? The AI revolution and what's going on with GPT-3 and 4. So there are reasons to be more optimistic about some of these tech names. And I think that's what's supporting the broader market, basically. Yeah, it's not a bad strategy. I mean, I always say on stock replacement, I prefer to go longer dated for sure. So because you keep your carry down anyways, even if you don't have a funding leg in the short end, earning you some theta back by going longer dated, you are kind of making it feel more like an outright long position anyway, because the theta is quite slow, right? Assuming you're going on leaps, you're going at least 1 year out, right, or more. But then and when you're choosing an in the money, again, this is something just conceptually to get your head around. Is like buying an in the money call is pretty similar to just being long the stock and buying a put against it, right? It's kind of the same thing, right? So think about it. You're long the name. You're buying a put in the long dated maturity to hedge, some deep downside, and then you're selling a call option to overwrite your long, basically, right? So that's also another way you can visualize your position, right? But systematically overwriting a long position that you've got in a long dated option, that's something I don't do it systematically, but when I've got a position and then there's been a move and the front end spikes, then that is definitely something I would do, just to bank some of that move and harvest some carry out of a position that I own. So yeah, I quite like that.
Given some of the notes that you had sent to me, it sounded like you will trade crypto. Is it fair to say that crypto trades kind of like options in the volatility and sort of convexity? I mean, there's it's all about the tails, I'd argue, even when it comes to crypto, but it's just not an option. It's at least in quotes, an asset.
But crypto options are pretty liquid, right? Yeah, so I trade crypto options mainly. I mean, I've got some crypto holdings, but those holdings have been acquired by the stuff that I've done in crypto options since 2020. So yeah, I mean, the great thing about the crypto options market is when you trade options as an active trader, then the dream ticket is when you've got an asset that moves a lot and the vol of the asset moves a lot. And crypto is that in spades, right? Like the range of crypto vol, at the lows it will go 30 to 40, and at the highs it will go to like 200, right? So that's an incredible range of implied volatility, right? And similarly, realized vol can do similar sort of things. Like S&P, I mean, the lows might be 10 vol and the highs might be 30 vol, right? Or once in a blue moon, once a decade, you might pop to 50 or 80 vol, but it's not very often. Whereas crypto, I mean, literally every few months you're swinging around from the lows to the highs of the range. So there's a lot to do as a vol trader in crypto. And then if you're a systematic guy who's trying to earn carry and earn yield, then there's usually a much juicier vol number to sell, to do that systematically, and which is why a lot of products have been created in the crypto space, like DeFi option vaults and things like that over the years, to take advantage of those higher implied vol levels that are quite consistent.
Let's talk about a longer term view. I myself think it's plausible that we hit nominal new highs this year. Nominal, I mean, obviously not after inflation, but that there's still a credit event out there, which is my whole melt up first and then events later in the year. But if you're going to try to play for new highs when it comes to options, is it as simple as just buy an out of the money call option, or are there more interesting, unique ways of positioning for from an options trading perspective?
That's a great question. A trade that I highlighted this week, what I was thinking about, similar to what you just said, like, can we actually get to new highs in a year's time, right, in stocks? And, because we've suddenly gone from higher for longer and rates are going to stay at 5% to like, okay, the pivot's done by June, right? And now we're cutting like so damn quickly. So I mean, I do think that scenario that equities might scream to new highs is potentially there because 2020 taught us that the market is not the economy, and the market responds to liquidity. It responds to what they're doing in rates, and if they are going to start cutting rates aggressively, then we know what the tech stocks are going to do. The tech stocks are already showing their hand in how much they've outperformed in the last few weeks, right? So if the tech stocks are going to go, the market's going to go. Now, volatility wise, it's tricky because when you trade an option, like you say, you don't know if you're going to get your rally fast enough or you get your timing right. So it's always nice to have a funding leg. So you might want to own call options on NASDAQ or S&P. And whilst they're call options, they're already going to trade at a little bit of a volatility discount because of the fact that there's a skew for puts and not for calls. But you could still get your timing wrong and be right about the market going higher and make no money because it just didn't rally fast enough. So for me, I always like to think, what can I fund this optionality with? Is there something I can sell against it? And the thing that I found quite interesting was TLT. So rates vol is obviously really high and really pumped. But if you look at TLT, it's been in the 100 to 110 range for months, right? So whilst the 2 years going berserk, whether the 2 year goes up or the 2 year goes down, we seem to be quite anchored in terms of the long end of the curve, right? So for me, I think selling like a wide strangle 1 year out on TLT to get some premium in the door, and then spending that premium on call options on S&P basically for a year, again 1 year out, that might be a really nice way to access the new all-time highs scenario in the face of the Fed has pivoted, but that's the front end that's collapsing and the curve is steepening, so the long end isn't just going to need to scream that much higher. And then so your TOT will stay in that wide range of the strangle that you've sold. Let's say something like 90 versus, you probably sell the 90 put against the 130 call on TLT. It's a pretty wide range for that thing. And then the premium you spend, you buy like some upside on S&P, and if we do go to new all-time highs, you're going to do pretty well. So that's kind of an out-of-the-box way of having that equity bullish view, but leaning against the idea that rates are going to be a bit more range bound on the long end.
Yeah, I can see that. I can certainly see that playing out in that way. I'm curious. I've talked to plenty of options traders before, and it seems like a lot of options traders tend to have a particular strategy or approach that they tend to go back to time and time again. So they have all these tools in the toolkit, all these different approaches, but there's one or two they find themselves using the most. For you personally, what's sort of your primary go-to options strategy?
I wouldn't say I've got one go-to one. I think I've got a bunch of them that are used for different scenarios, right? So, like, let's go for the scenario that I just think an asset's not going to move very much, right? I think an asset's going to be quite range bound. It's not going to move much. Typically, I'll do an iron condor, and the iron condor expiry will be anywhere between 1 and 4 weeks, let's say, something like that, because I want to earn my money quickly, but I want to be protected in case I'm wrong. So I'm willing to basically not be outright short vol and make as much as I would make if I was right in that scenario, because I want to cover my tail risk, right? So the iron condor strategy is my short vol strategy that I quite like to do, and I employ that quite a lot in things that I want to sell and earn premium off. And then when markets dip, for example, and vol pops, generally when markets, certainly equities, when markets go down, implied vol rallies, and if you want to then buy the dip, the way to safely buy the dip is via call spread, call ratio, call ladder type structures. So these are not too long vol. They're buying the market, so they're trying to get long delta, but they know that when the market does bounce, vol's going to come back down. So you're going to run into some short optionality. So the trade performs really well, because if you buy the dip and it wasn't a good time to buy the dip, you've spent next to no premium. But if the market does rally into your short vol, you have very high confidence that the vol is going to get crushed, right? So the risk reward of those type of ways of buying the dip is far superior to just buying stock or buying futures, right? That's kind of those are some of my go-tos. Oh, actually, and one
What?
more. One
Yeah,
more
please.
go to is when we get VIX spikes, I often buy puts on the VIX. I often like buying puts on the VIX as a way of fading a VIX spike, basically. That often does pretty well.
Yeah, the challenge, as you know, of course, is that if it ends up being like a 2020, right? You can get fade. You can fade a VIX level of 40, but then it goes to 80, right? So
Exactly. Yeah.
that's always the challenge. It's like it sounds easy to counter the VIX, but VIX spikes tend to not stay elevated for a while, but the VIX tends to be funny in the way it tends to go further than people think in every round of a decline. I'm also curious if you how close you might track sort of dealer positioning. I had Jem Carson, one of these Twitter spaces not too long ago. His big thing is look at dealer positioning, try to see where there might be outsized contrarian squeezes. Anything that you've been observing that in the options market makes you say to yourself, you know what, too many people are positioned for this particular tail. It's time to bet the other way.
I wouldn't say there's. I mean, I think the skew's quite pumped now compared to where it was. So it is making me think that the S&P is getting quite close to bottoming out, right? Even though it hasn't come down that much, I just now think that the skew is repriced. People have got a bit more comfortable with that downside tail, and it's not like being priced at zero anymore. So that actually is going to be more supportive to the market. Um, but the dealer positioning thing, I do track it. Like, I'm good friends with Brent at Spot Gamma. And we've got a joint sort of. I did a course on their platform, so we've got a partnership, and I do definitely monitor what's going on there. But what I like to do is I like to see the price action in volatility confirming what the positioning models are saying. Because the positioning models make assumptions. They make assumptions about which way round the dealers are in certain strikes. Okay. So all the downside strikes, dealers are assumed to be short. All the upside strikes, dealers are assumed to be long. And that's not always the case. But that is the majority. And so it is true to some extent. It's just the question, you don't know how far. You don't know if there's like some big trade that's skewing it the other way that you need to be aware of. So what I like to do is I like to say we're going to an area where the street is supposedly short gamma, yet the price action in implied vol and options is not confirming that everyone's short, because the market's moving a lot. If the market's moving a lot and everyone's short, then everyone's going to be wanting to reduce that short, and so they'd be bidding for vol, yet vol's not catching a bid. If vol's not catching a bid, then I am not going to believe the model and the positioning so much. Whereas in times where the market rallies towards areas where we are supposedly long gamma and the vol gets annihilated, the implied vol does, because everyone's trying to sell options, and the realized vol also collapses because everyone is long gamma and their hedging activity is compressing moves. That's when I'm getting more interested, because I'm like, so the model suggests this, the price action suggests this, and the realized suggests this. I think I'm going to back that view. That probably is the real positioning setup. So then let me think about how to lean against that and how to trade against that. But I think you need to factor in the vol price action to really feel more confident that the positioning models are correct, because there is a lot of assumption in those models.
Just given that you're interacting with professional options traders and new options traders, what do you think people that are new to options trading get most wrong, and what do people that are longtime options traders get most wrong? The two, I'm going to assume, are going to be very different answers.
Yes, so I think I alluded to the first one, like for new traders, I think they just make the mistake of going too short dated on their views, right? Too short dated, they get sucked into the idea that they're gonna make 5x, 10x, 30x, whatever it is on a trade, right? But they don't realize that they're fighting the theta monster, and if they're off by a week or a few days, then the premiums are gone, basically, right? So I think that's the mistake a lot of people make. And then I would say the professionals, for sure, in my experience, that they'll get their hedge on. They'll see a problem coming in the market. They'll get their hedge on. The market will then sell off, and they'll be like a rabbit in the headlights as to what to do with the hedge, right? Because they're like, okay, it's protecting me, but I don't know when the sell-off's going to finish, so I still need to keep the hedge. What do I do? Like, I can't do anything. I'm paralyzed, right? And that I used to spend time actually visiting institutions, walking them through potential hedging, what to do, how to monetize and restructure your hedge so that your hedge doesn't just end up being a pointless activity. Because it's like, ultimately the hedging program of these institutions is going to end up costing money over the long term, right? But it's to smooth out their risk adjusted P&L that they're doing it, right? But if they had a little bit more intelligence about the way they monetized it, when it went correctly for them, when it actually protected them, then they might be able to finance it even better and end up with a hedging program that didn't cost them anything, right? So that's the thing I've seen a lot of institutions not do particularly well historically.
I think that's a good place to wrap this Twitter space up, given that I have another one in 10 minutes. Thank everybody for joining. Again, show some support to Imran, and hopefully I will see you shortly, everybody. Thank you, Imran. Really do appreciate it.
Oh, Michael, thanks for having me on. I really appreciate you inviting me.
And thank you, Miguel, as always, for great questions. Thank you, everybody, too. And thank you for the clapping. See you, everybody. Thanks.
Take care, everyone. Cheers.